Welcome back to Investing Talk podcast.
Today we're looking at Navitas Semiconductor.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really do read every comment, and your suggestions drive what we look at next.
And we have a really fascinating one today because this name has been lighting up the request queue for a while.
Yeah.
Everyone wants to know if this is the real deal or, just another hype train.
Right.
But if you want the hook right up front, don't think of Navitas as just another chip company. You really need to think of them as the ultimate pick and shovel play for the AI energy crisis.
The energy crisis.
Exactly. While everyone is completely obsessed with the GPUs, the NVIDIAs of the world, nobody's paying enough attention to the actual plug. Navitas, well, they handle the massive power loads those GPUs require. They're solving the physics problem of how you power the future without, melting the entire grid.
Okay, and that sounds fantastic on a slide deck. We all love a good infrastructure play. But here's the so what that we need to hit right at the top. While that story is powerful, the financials right now, they look messy. And that is being generous. I mean, we are talking about a company that is just burning cash to chase a future that hasn't fully arrived on the balance sheet yet.
That's fair, and we're definitely going to get into those gritty details. But the opportunity here is really about physics versus finance. It's about whether they can survive this transition long enough to become the new standard.
Physics versus finance. I like that. All right, let's dive into the hard numbers. Segment 1, fundamentals. And I have to be the bearer of bad news right out of the gate here.
Oh, go on.
If you just pull up the latest earnings report, Q3 2025, it is ugly.
Ugly is a strong word.
I think it's accurate. Revenue came in at just $10.1 million for the quarter. That's a massive 53.4% decline year over year.
Wow.
You literally cut your revenue in half. The trailing 12-month revenue is sitting at just $56.6 million. But here's the kicker. The thing that really made my eyes water. The net income is negative $125 million for the trailing 12 months.
Yeah.
That gives you a net margin of negative 220.85%.
It sounds alarming when you put it that way, yeah.
And how can it not? They're losing more than $2 for every single dollar they bring in. How do you even begin to defend that?
You defend it by looking at the context. This isn't a company that just, forgot how to sell things. This revenue drop is intentional. It's all part of a strategic pivot they are calling Navitas 2.0.
Navitas 2.0. Okay, let's unpack that. Is that
Right.
just corporate speak for our old business isn't working anymore?
Not exactly. See, previously, a lot of their revenue came from consumer electronics. Think fast chargers for phones, laptop adapters, that kind of thing.
Right, low margin stuff.
Exactly. The margins there are thin, competition is fierce, so they made a deliberate choice to move away from those consumer goods and go all in on high-power AI data centers and industrial applications.
So they're knowingly sacrificing the present for a bigger prize in the future.
That's the play. They're clearing the decks. And if you look closely, you can actually see the resilience. Full year 2024 revenue was actually up 4.84% to $83 million. So before this pivot really started to bite, they were growing. They're just taking the hit now to fill the books with much more profitable orders later on.
Okay, I can buy the pivot narrative conceptually, but a pivot like that requires a runway. If you're burning $125 million a year, you better have a lot of cash in the bank or you're going to hit a wall fast.
And that is the saving grace here. Their financial health is actually much, much stronger than that income statement suggests. They've got total assets around $430 million.
$430 million. Okay, that buys them some time.
It buys them plenty of time. Their current ratio is 7.9. Yeah, and for those who don't know, that measures your ability to pay your short-term bills. Anything over 2 is usually considered pretty good. 7.9 means they have massive liquidity. They're not going bankrupt anytime soon. And they're using that cash pile to heavily reinvest. Over $13 million going straight into R&D.
Which brings us to the moat. Why are they spending all that money? What's so special about their tech that makes them think they can beat the established giants?
It all comes down to the materials. We're talking about gallium nitride or GaN and silicon carbide or SECIT.
Right, we hear these acronyms thrown around a lot. GaN and Psyche. Why do they matter so much for AI?
Think of traditional silicon chips, like old copper wiring in a house. It works, but it has its limits. When you try to push the amount of power needed for a modern NVIDIA AI server through standard silicon, it just gets too hot and it's wildly inefficient.
Okay.
Navitas chips using GaN and SECIT, they enable these 800-volt architectures.
800-volt architectures, that sounds serious.
It is. That's the new standard for high-performance data centers. Navitas chips offer much higher energy density. That means you can pack more power into a smaller space, and you save a ton of energy. For a data center operator, energy is their single biggest ongoing cost.
Right.
So if Navitas can save you millions on your electric bill and let you run your GPUs faster because they aren't overheating, well, that's a killer application.
So they're basically selling efficiency into a world that is desperate for power.
Precisely. And they have the carbon neutral certification, which is a massive selling point for these hyperscalers who have ESG targets to hit. They need to be green, and Navitas helps them get there.
All right, so the tech is the real deal, even if the current revenue is in this transition trough. Let's pivot to the charts, because if the fundamentals are messy, the price action is, well, it's explosive.
Explosive is exactly the right word. If you look at just the last year, the stock is up nearly 200%.
200%.
And just in the last month alone, leading up to January 17th, 2026, it surged 40%. We're looking at a close around $10.91 as of January 16th.
That is just a massive run. But this is where I have to put my skepticism hat back on. When something runs that hot, that fast, it almost always brings extreme volatility. And looking at the data, the beta on this stock is over 3.15.
That is high.
It's extremely high. A beta of 1 means you move with the market. 3.15 means you are 3 times as volatile as the S&P 500. If the market sneezes, Navitas catches a nasty flu.
Or if the market rallies, Navitas goes to the moon. It cuts both ways.
True, but look at the 52-week range. It's been as low as $1.52 and as high as $17.79. That is a wild ride for any investor.
It is.
And just recently, we saw a gap up on the chart followed immediately by a 9.7% pullback. That tells me there's some serious psychological resistance right around that $11 mark. People are taking profits.
There's definitely profit taking, but look at the underlying structure. The stock is trading well above its 50-day moving average, which is at 852, and its 200-day, which is at 814. In technical terms, that confirms a strong bullish trend. The floor keeps rising.
And what about the volume? Is this just, retail hype?
It's heavy. This recent rally wasn't just retail traders on forums. The volume strongly suggests institutional appetite. Big money is starting to position itself here, and they're likely betting on that Navitas 2.0 story we just talked about.
Okay, so the charts are bullish but very, very volatile. Let's shift gears now to market psychology. What's the sentiment out there on the street?
Currently, the quantitative sentiment is flashing moderately bullish.
What's driving that?
A lot of it came out of the Needham Growth Conference on January 14th. There was significant buzz there about their AI power capabilities. I mean, when you get in front of investors and show them the roadmap for powering the next generation of NVIDIA chips, people get pretty excited.
But this is where things get really weird for me. We have this moderately bullish sentiment. We have the stock up 200%. But then you look at the professional analysts.
Disconnect.
There is a massive disconnect here. The stock's trading around $11, but the analyst consensus targets are stuck between $6.40 and $6.48.
It's a huge gap.
It's not just a gap, it's a chasm. The consensus rating is hold or buy, but their price targets imply the stock should crash 40% from here. So my question is the market irrational, or are the analysts just completely asleep at the wheel?
I think it's a classic case of analysts being reactive rather than proactive.
Yeah.
The prices move so fast. I mean, remember, 40% in 1 month, that their models just haven't caught up. They're waiting for the earnings execution to justify raising those targets.
Or maybe they're seeing something the market is ignoring. Because here's another data point that makes me pretty nervous: insider activity. Insiders have been net sellers. And not just a little. We're talking over $29 million worth of shares. That's 3.3 million shares sold in just the last 90 days.
That is a significant amount.
So if the management team really believes Navitas 2.0 is about to send this thing to the moon, why are they cashing out $29 million right now?
Well, to be fair, if your stock went up 200% in a year, you'd probably take some chips off the table too.
Right.
It's pretty common for executives to diversify their personal holdings. They can't eat stock certificates,
Maybe. Or maybe it signals a lack of faith in the current valuation. It's a red flag I just can't ignore.
It's a valid concern. But you have to balance that against what's happening on the rumor mill. There's heavy speculation, and I want to stress, this is just speculation, that the Navitas 2.0 delivery could mirror the kind of upside we saw in NVIDIA.
Wow.
The market is just desperate for power efficiency. If Navitas proves they're the key to unlocking that, the current valuation, even at $11, could look very cheap in a couple of years.
If is doing a lot of heavy lifting in that sentence. And that brings us perfectly to the dangers. Let's talk about the bear case. If I'm looking at this stock, what should keep me up at night?
Lay it out.
First, the financials. We already hit on it, but you just cannot ignore a negative 220% margin. They are losing money on every single dollar of revenue right now. That's sustainable for a little while, but not forever.
Agreed.
Second, the valuation. Like we said, the price is completely detached from the fundamentals and from the analyst targets. You are paying a huge premium for a story that has not happened yet.
It's a growth multiple, for sure.
Third, dilution risk. There's talk of PE overhang in the background. If this Navitas 2.0 pivot takes too long, if there are delays in getting qualified with the big data centers, they might need to raise more cash.
Which means issuing more stock.
Exactly, which dilutes existing shareholders. And finally, competition. They aren't the only ones playing in the GaN and SiC space. You have giants like Infineon and On Semiconductor. These guys have deep pockets, established relationships, and they aren't going to just let Navitas take this market without a fight.
True.
While Navitas might have the IP edge for now, Infineon can outspend them 10-1 without even blinking.
True. But history is filled with nimble innovators disrupting the giants who were too slow to adapt.
But the giants can also crush the innovators before they get big enough. And we have a catalyst coming up that might decide which way this goes. Earnings are on February 23rd, 2026.
That is absolutely the date to circle on your calendar.
The consensus EPS is expected to be negative 51 cents. If they miss revenue targets again, or if there's any sign at all that the pivot is delayed, this stock could get crushed. Remember that beta of over 3? It cuts both ways.
It absolutely does.
So we have a company with bleeding financials, but incredible, maybe essential tech. It's trading at all-time highs with insider selling, but the market is buzzing about an AI revolution. What is the final verdict?
For me, looking at the combination of their proprietary tech and the massive tailwinds from the AI infrastructure build-out, I'm giving this a bullish score of 7 out of 10.
A 7 out of 10, that's fairly confident.
It is. Here's the investment thesis in a nutshell. This is a high-risk, high-reward play on the physics of AI. Data centers are literally running out of power. Navitas solves that problem with Go and SiC.
So you're betting on the sheer necessity of the technology.
Exactly. And my timeline here is kind of twofold. There's a potential swing trade opportunity leading into the February earnings because the momentum is just so strong. But the real play, the one that could generate real wealth, is a multi-year hold for that 2026 inflection point where AI demand just absolutely explodes.
I agree on the tech story, but I have to warn listeners to size their positions carefully. The volatility and that insider selling, you have to respect the risk.
Fair enough. It's a buy. But for the risk-tolerant investor who truly believes in the AI infrastructure build-out.
There you have it. Make sure to subscribe, like, and comment on what stock we should cover next. We'll see you in the next one.